Hey everyone, thank you for attending the Place Your Trades Network Spaces covering oil, nat gas, LNG, and trading. Spaces is brought to you by Tradeabate, which has a built-in custom app dedicated to trading CME Group's new daily option contracts. You can use the link in my Twitter stream to go get the Tradeabate app for free. I also write a weekly blog that's out on Sundays covering the markets that you can find at placeyourtrades.com. That's absolutely free. And then over the next month, well, actually until the 28th, Place Your Trades is giving away a free trip to Vegas. So one winner will be able to join the Place Your Trades team at the Money Show on April 24th to 26th. All you have to do is go to placeyourtrades.com/Vegas and sign up before March 1st. And then on the 1st, we will be picking one winner to join. All right, so our guest, and I'll introduce our guest this week. We have Andrea Palatrieri. I hope I said that right. I'm sorry, my Italian's terrible. Who is an associate professor in banking and finance at Catholic University of the Sacred Heart, Milan. He got his PhD in business administration at the University of Verona. He has been for 7 years an assistant professor of banking and finance at the University of Udine. His main fields of research deal with Islamic finance, especially Sukuk and Islamic banks, sovereign wealth funds in terms of asset allocation and impact on global financial crisis, commodities, and finance bibliometric reviews. He's the author of several papers published in academic journals. And he is also the associate editor of 3 academic journals. He is also well-versed on LNG and nat gas markets, which he tweets about a lot. Next we have, who probably doesn't need much of an introduction, but we have Dr. Anas El-Haji. He's the keynote speaker, author, and energy markets expert. He offers a big picture approach to energy issues that help investors and decision makers articulate the issues and avoid decision biases. His company, Energy Outlook Advisors, is an independent research and advisory firm that focuses on outlook of energy markets and disruptive technologies, as well as energy-related geopolitics, policies, and security guidelines. He also has a great Substack, the Energy Outlook Advisors newsletter covering energy markets, which include oil, gas, renewable energy, hydrogen, and technology. And last but not least, we have Bob Iacino, another one of those Italian names I can't pronounce, who started in 1993 in commodities, interest rates, FX, and equity markets. In 2013, Bob joined Tethys Partners as their chief market strategist. In 2015, Bob and his trading partner founded Path Trading Partners, which is a boutique analytics firm. In 2018, Bob also founded Kingston Market Research, a financial research and content company focused on small to medium-sized institution and retail investors. He also is co-host and producer of the Futures Edge podcast, which is also fantastic. So now that I've introduced everybody, I just wanted to make a note of a couple of the EIA numbers. We did have over 7 million build, but we did have a huge adjustment factor of 14.511 million barrels on the week. Exports were up, imports were down. Good news is implied demand was up at 20.2 million barrels per day, so we're up at 20.2 million barrels per day, and we're still on refinery maintenance, so we still have refineries operating at 85.9%, and we still managed a gasoline draw. So with that, we're going to move forward. I'm going to start with Andrea. So obviously everybody is talking about nat gas stunning 70% fall from last summer high. We know that storage is obviously very important, and as well as overall Henry Hub supply and demand balance and projected EOS storage in March and November. Can you kind of walk us through that and tell us a little bit about where we're at?
Thank you, Tracy, for inviting me. And I would say from Italy, good afternoon, everyone, or good evening. So first of all, I would like to briefly comment the nat gas storage number right now. We had 1 hour ago a draw of 71 billion cubic feet. That was a little bit on the bullish side compared to the market estimates. My model had a kind of 73 BCF draw, and I was missing a couple of parts, especially the Midwest and the Pacific side. But bearing this kind of number that although it can consider kind of bullish, on my side is a little bit bearish because the South Central and the Salt draw that was not a draw, but was a zero injection and draw. I can consider it a little bit bearish compared to what the market expected. So bearing this kind of draw, I have a projected end of season storage number for March right now, 1.95 TCF. That is a very bad number. So again, the market, as you told in a very good way, is under pressure. Again, last couple of days, we had a huge rebound after touching one handle 2 days ago. But again, this rebound could have been part of the bid week effect. Right now, we are in the middle of bid week. We will have the expo of H contracts, so the March contract. And right now we are having some kind of HJ, so the widowmaker adjustment before the future expiration. Having said that, my projected end of season for the end of the season in November are more than 4 TCF, 4.1 TCF. So again, what I can say is that this market is on the bearish side, fundamentally side. We have a lot of production right now that is not coming back. We need some kind of production cut that could be easily got at these prices, even below $2 per million British thermal unit. Right now, I don't see it. So again, the power burns are not enough to alleviate this issue, especially related to South Central. So again, on the fundamental side, Tracy, I don't see anything bullish, burning some power burns and some Freeport stuff down the road that I can talk about in the next few minutes.
What do you, we've had a lot of companies come out and say, at these prices, they're going to cut production. How long do you think that would take to filter into the market?
Yeah, I see, for example, I know that you maybe refer to Cheniere results, and even Cheniere told us a couple of days ago, yesterday, that they're gonna cut some kind of production or or even they stop the drilling activity. So my idea right now is that I have to check Permian Basin and Nashville. That I would say those are the most important parts in the production side, since Nashville and even Permian Basin can be some kind of marginal provider in production side. Having said that, right now, even today, I have a lower dry 48 production data close to the all-time highs, so close to 102 BCF, with no signs of cutting production. So again, even if there are some announcements effect, and I can tell you about Cheniere, then for now, I don't see this sign on daily supply-demand balance. And I can understand this stuff because on the one side, there are long-time contracts that the guys need to respect. On the other side, again, the rates are coming higher. Even today, we we all know, check the data related to the jobless claims, and even the job market is quite strong, so maybe rates can be higher than market expectation, especially in terms of terminal rate. But even with this kind of rate, I see people that keep flowing in terms of production, and I do think that really prices of production cut can be really lower compared to the $2 that we talked about before. So my idea is to try to see some kind of production cut on the area 1.75, $1.5 per British thermal unit, Tracy.
Excellent, thank you. Well, we're going to come back and talk more about nat gas, but I want to move to Anas and talk about, so yesterday there was a Reuters article talking about how Iraq is going to allow trade with China in yuan, and US versus yuan Twitter was in an uproar. But then later that day, you dropped a bomb of an insight on this. Can you kind of tell us about this regarding Iraq and oil purchases?
Thank you, Tracy, and thank you for inviting me today. Hello, everyone. Yes, yesterday I dropped that bomb, but it was a very small one. Here is the big one. The big one basically is this, that the decision of the central bank was limited only to the private sector that import from China, and it's mostly about regulating exchange rates within the country. It does not apply to oil. That's what we said yesterday. So all those guys, especially mostly gold traders who go crazy about these things and say, look, oil is being priced in non-dollar and revenues are in non-dollar and oil countries are dumping the dollar, etc. So here's the big bomb today. Some people on Twitter went crazy over the idea that China signed a deal in 2019. They called it the oil for construction deal. And they said all the money basically that Iraq gets from China is going toward construction, and this is a barter deal. Here is the bomb. First, the deal that's been signed is only for 100,000 barrels a day, and Iraq exports 1.1 million barrels a day. So, based on the deal, the amount is so small. Here is the news. The deal never been implemented. So all those guys on Twitter who went crazy talking about it's a barter deal and this, there is no deal. It's on paper. People, get it. This is the information. And it really angered me when someone who does not have any information but reading CNN to start preaching and telling people about a deal that does not exist except on paper. But here is the bigger bomb. Even within that deal, it is a dollar deal. It's not a yuan deal. And yes, Iraq did deposit money in Chinese banks, and that money got transferred from New York, and it's in dollars, and the account is in dollars. It's not in yuan. Until today, all Iraq oil revenues go through New York. Period. End of story. Back to you, Tracy.
Yeah, I was going, I kind of wanted to ask about this as well. I mean, given that since they said this deal doesn't include oil, I mean, given that Iraq's major, total exports, like 96.9% of total exports are mineral fuels and oil and products. So that wouldn't make much of a, if China buys some other random things in yuan, that's not really that big of a deal, correct?
I mean, let's go back to just for those who did not get the first part. The Iraqi central bank decision is related to the imports of the Iraqi private sector from China. It has nothing to do with exports. It is about Iraqi exports. It is about Iraqi imports by the private sector from China. And the reason why, because the black market for exchange rate, for Forex basically, is rampant. And that's affecting the ability of the central bank basically to control the exchange rates. So they are kind of adopting policies trying to minimize the effect of it and have more control of that black market. But in general, and for those who are interested, they can go back either to our Substack where we discussed the Chinese premier visit to Saudi Arabia when he asked those countries to trade in yuan. And we made the case that this is not going to happen. And this is not going to happen for many reasons. And one of the main reasons why, because if you look at the Saudi Riyal or the Emirati Dirham or all the other GCC countries' currencies, all of them are pegged to the US dollar, except the Kuwaiti dinar. Basically, it's pegged to a basket of currencies where the dollar basically is a king in it anyway. So the idea here is why they need to shoot themselves in the foot by lowering the dollar and lowering their currencies by shifting to the yuan. So that's number one. Number two, the all the trade, the Saudi trade with China per year is only 50 billion. The global trade in dollar in oil last year, I think it was about 1.4 trillion dollars. So the impact, even if they go that route, which they are not going to go for many reasons, for those interested, they can read it, or we have a 2-hour space, they can listen to it. But the idea here is, even if they go that route, the impact is minimal. Back to you.
Super. And then I also wanted to talk about, so you noted that, you noted the other day that, oil market data quality has been deteriorating since like 2017, and now we have a huge black market in oil, and data quality is only going to get worse. So what are the implications of this for people that are, trying to track barrels?
I am making the case for my Substack.
Okay. Fair enough. Fair enough.
This is just a joke. No, we've noticed the deterioration in the data since 2017. I think I know why, but I don't want to speak about it publicly, especially when it comes to the IEA, to the EIA. The IEA, okay, we have EIA, that the Energy Information Administration, that's the US, and we have the IEA, the International Energy Agency. The International Energy Agency numbers basically are way off. The forecasts are way off since they went crazy on climate change, and they just stopped doing what they do best, and that's where the data basically went wrong. Even if you recall, last year OPEC decided to exclude IEA data because it was way off. But the idea here is, with this massive black market that we have, and many ghost ships are going around, the data is just getting worse. And what happened is, we have some media outlets that follow the shipping only if the ship can be tracked, and then they write reports on that. So they'll tell you, well, Iran exports was 470,000 barrels a day last month. Well, that's only what they can track electronically, and this is the wrong data. And by contributing to that and publishing a story like this, knowing that there are another 700,000 in ghost ships around, they are providing misleading information. And the media that does that basically got to stop. This is really making the situation worse. If you look at the forecasts, and if you look at the market, Bloomberg been asking experts about oil prices for a very long time. And what's strange about this data is the accuracy of the forecast is 50-50, which means that anyone who knows nothing about the oil market, if they flip a coin, they are as good as any analyst in the oil market. And one of the reasons basically is the media reporting of those stories. You have a story 2 days ago about oil prices declining because of doubt about demand. the decline was only 32 cents. And then they make up a story about oil demand. We all know 32 cents change. This is just normal. Has nothing to do with anything else. But here I would like to mention a few things, please. We have, when we talk about the EIA adjustment and we talk about, doubts about the EIA numbers, the fact is, and please pay attention to this, everyone, inventories are measured independently, which means that there are not a difference between two things and one of them is wrong. So inventories could be correct and everything else is wrong. So let's be clear on this. So if you look at the EIA formula, the formula is very simple formula. On the left side, you have domestic production plus imports, and that's the supply. And then on the right side, you have the demand, that's refinery inputs. And the reason why we say refinery inputs, because we as people do not consume or use crude oil. We use products. Refineries use crude oil. So on the right side, you have the refinery inputs plus what we export plus inventory change. The inventory change basically is reported. If companies are lying, they are liable because the law basically forced them to report with accuracy. And if there is a problem, they have a certain number of days to report so they can make the adjustment. But the idea here that the issue is not with the inventories. The issue is when we talk about the adjustment in the formula is somewhere else. They need to equalize both sides, and the adjustment is always the difference. That's number one. Number two, which one is more accurate, EIA or the API? We all have those discussions over the years. And the fact is, API is voluntary and the EIA is mandatory. But given the fact that it is mandatory, does not give it a leg over the API. The API people constantly says that their data is more accurate than the EIA. And there is some truth to that. And the reason why, because when the data is mandatory and you have to submit this within a certain time, then most likely you are going to write any number to meet the deadline. Because if you don't meet the deadline, there is a punishment mechanism or something that you have to abide by the law. So given the fact that it's mandatory, does not give it a leg over the API. The fact is, the market is going to believe whatever it believes, and whatever the number that the market believes in, that's the true number, and that's it. Well, regardless of what the EIA is reported or the API. The third point, and I think I'll end with this, and this is probably the most important takeaway today. We've seen a massive increase in inventories. We are close to 480 million barrels. 480 is enough to bring prices to about $60, but it did not happen. Why? The reason why, because in a study that we did over 20 years ago, and we kept updating, it shows that if you do the simulation, it shows that there is a substitution between commercial inventories and the SPR. So the SPR declined to levels where commercial inventories have to increase, and therefore the impact on prices is less. Back to you, Tracy.
Thank you. And I have more questions for you, but I'm going to move to Bob really quickly because I kind of want to talk about, trading this market. So I wanted to ask Bob first, kind of what is your macro view over, say, the next 6 months, a year, and how are you approaching this market, trading this market right now? In other words, is that futures, equities, options, or no position?
Well, currently, and thanks for having me again, and I want to thank Anas for his last few comments, actually for all of them, but especially the ones about breaking down the Iraqi deal for Chinese yuan, because I saw that story, and I just kind of said, well, and this is to the trading question, Tracy, I said, I don't understand what this story means and what the fallout of the story could be. So I'm not going to trade gold based off of it. I'm not going to trade crude based off of it. I'm not going to trade the dollar index based off of it. So having said that, when I look at oil specifically, it's always the future side for me. I've been on several television interviews where people have said, okay, so you're bullish oil, what stocks are you looking at? Or you're bearish oil, what oil stocks are you looking at? And my answer is always the same thing, that if I have an opinion in crude oil, I want to trade it in crude oil because the only thing that's 100% correlated to WTI's price is WTI. So that's generally where I will trade it. Having said that, I'm positionless right now. And the reason is the way that we look at the crude oil markets, actually any market, is we look for breakouts and then we look for retests of the breakout level. And that's, I'm simplifying it, of course, but right now crude oil is doing something that crude oil does and does a lot. Over the last 12 weeks or so, crude oil has been in a slightly upward shaped sideways range. And you can see these on the crude oil chart all the time. You can see perfectly sideways channels. One of the most obvious is you go back to approximately late April 2019 through, let's say, late January of 2020. And you're looking at a sideways channel there that once it broke out, it trended. So the characteristic of the crude oil future specifically is the supply and demand market, right? So when we're in these channels, supply and demand in the very short term is basically balanced. Obviously, there's a lot of speculation within the ranges, and the particular range I'm talking about currently is pretty wide. It's from about $72 all the way up to about $83. And that's typical for crude oil. And what happens is there's a supply or demand disruption. And when that supply or demand disruption starts to break out, when there's anticipation of the disruption or early stories of the disruption, we get these breakouts. And then you get several opportunities as a trader to get into some part of the move. And I don't have that right now. I don't have it at all. What I have is a down move that from a price action perspective is getting a little bit long in the tooth. And I suspect that's why this particular channel that I just mentioned, which again is only about 12 weeks old, is slightly upward sloping because you've got some short covering in that from the moves. I mean, you can call it the move from the high of March 7th of 2022, or you can call it from June 13th highs of 2022. But either way, the sell-off has just gotten a little old. And from that perspective, I kind of want to see the next breakout. And I suspect that the next breakout, the next long-term breakout, will be to higher prices. I don't necessarily think we'll get 110, 115, 120, but I do think we have a shot at $100. And we're starting to get into a period of time, not quite yet, but as we get into March, where there's going to be a small seasonal tailwind to crude oil. And it's a pretty long duration tailwind. Obviously, as we start to get ready for the summer driving season, we're going to see refinery turn around and slow down or end, in which case we can actually see that refinery demand start to pick up, and we'll start to see some, again, typical seasonal draws on the EIA report. And so when we see that, if China actually starts kicking in a way that a lot of speculators have expected them to, which we haven't really seen yet. We've seen a little bit of increased demand, but not typical Chinese demand. They're not even at pre-pandemic levels yet. And then we get the increase in demand from India that's expected, somewhere in the range of 4 to 5 increase in demand there. To me, it's likely that we get to $95 fairly easily and probably touch 100 before that sort of balance starts to come back into play, and possibly OPEC increases production if they can. And then longer term, I'm somewhat opinionless because crude oil to me is more of a medium-term trading vehicle, at least the way that we look at it. So right now I don't have an opinion, but I would lean probably 51% toward an upside breakout. But again, as a trader, medium-term trader, but still a trader, I will just go where the price takes me. I don't try to pick bottoms, and I don't try to pick tops. I've never done that.
And then I had another question. So we have for the past couple of years, right, we've seen oil kind of be the inflation hedge, right? As we've seen inflation expectations rise. Now those have come down since the Fed started hiking, but we are starting to see inflation expectations rise again in the 2-year and 5-year, but oil's not really rising along with it. Do you have a theory on that?
Yeah, I suspect it has a lot to do with the markets finally accepting that the Fed is probably not fibbing when they say that they need to get the terminal rate a little bit higher and then they need to hold it there for a while. You know, it's funny, gasoline prices have kind of snuck up on everybody. I mean, if you just look at this morning's national average versus, say, a year ago, regular is about 340, and about a year ago it was about 354. You go to premium, and premium is about 414, and a year ago it was 415. So if you go to the inflation measurements from a year ago, people were pretty much in a panic about where inflation was going to be and where it was going. The interesting thing for me about the crude oil portion of this is crude oil and copper specifically started out with these sort of slow grinding rises higher. And I think that's part of what people are starting to believe. I mean, I should say the people that are starting to believe, not what people are starting to believe, that inflation might have another leg. You know, inflation didn't go up all at once in a straight line, and it's not likely to go down all at once in a straight line anyway. And we still haven't really seen any deflation. We've only seen disinflation. So I suspect that crude oil is probably priced well enough now to stabilize the thought process that deflation isn't coming very soon. And then again, as we get that tailwind, as we get into what I think is going to be a slow grind up to about $95 to 100, that'll trigger it and be part, you know, moving toward that inflation hedge idea that you mentioned.
That that definitely makes sense. And so, I mean, do you think the Fed do you think the Fed can do anything? I mean, they're raising rates, but we're still going to see inflation move higher. So does that mean they're stuck, or?
They're very stuck. So we've all heard this conversation about, you know, soft landing, hard landing, and now all of a sudden there's no landing. There was another phrase being thrown about a few weeks ago. It's called immaculate disinflation, where there wasn't going to be a recession. And I'm still in the recession camp. One of the things that I've talked about a lot lately is the probability of recession to me has not shrunk. It's just been pushed back. So maybe mid 2024, late 2024. And inflation is part of the reason. And so when you look at what risk assets have done over the last, let's say the last 10 days or so. The stock market specifically was fighting the Fed. The bond market wasn't. Copper, crude oil, they weren't either. And you had to sit there and say, okay, which one is going to be wrong? And my money is always on the bond market over the stock market. So the Fed is very stuck. And I think the reason that people did not believe, and you know, a lot of people still don't, that the Fed would have the courage, for lack of a better word, to actually take rates to the terminal level that they talked about, maybe even higher, and then leave them there, was because people did not believe that Jay Powell and this particular Fed would be okay with driving the economy into a recession. I personally believe they are okay with it because I think they believe that they can bring the market right back, or the economy right back out of a recession fairly quickly. But they have to get inflation down. You know, wages at some point will slow, especially as you see all these layoffs. Now, one of the things that's holding the jobs numbers higher is a lot of companies, and I saw this on a survey, a lot of companies are very reluctant to lay off and fire in the numbers that they probably should as this particular slowdown gets started, simply because they had such a hard time hiring people over the last 18 months, and they just don't want to lose people. But at some point, earnings force that particular situation. They just force it. But when people come back, that's when they're likely to come back to work for lower wages, and that's when inflation can actually be pushed back. It's a strange thing, Tracy, because we're looking at what some people might call pretty immoral, where you've got, you know, an unelected government agency that is basically, you know, saying without saying, we need a lot of you to lose your jobs. in order for the economy to be better. It's a strange thing to say, but the worst economic situation for assets anyway, for risk assets, is stagflation. So a stagnant economy and inflation. So if they push us into a recession and inflation doesn't budge, that's really bad for people's 401ks, and it's really bad for equities and risk assets.
Well, on that fun note, I'm going to come back to you. I'm going to talk to Andre a little bit more about natural gas. So I kind of wanted to talk about one. Can you tell us a little bit, because everybody's waiting for Freeport to open, and this is going to be a huge deal for U.S. nat gas. So can you kind of talk us through the Freeport reopening? What will be the impact? How much of an impact will be on Henry Hub and TTF, which is Dutch nat gas, for those that don't know?
Yeah, Tracy, this is really an interesting question because I, even with Anas, I see a lot of people in Twitter being a little bit, I would say, enthusiastic about Freeport this time rather than oil. So those are my points. First of all, personally, like all the other netting analysts, I have Freeport coming back from February 15. So right now we are February 23rd. And so any news Freeport side on my model is bearish. What I mean with this? I mean that after several adjustments in my model, I suppose that Freeport came back with kind of 2.2 BCF day from mid-Feb. Right now, we are February 23rd, and I have in the daily balance just 0.8 BCF today. So, which is the point of those numbers? The point is that until we have Freeport online on the maximum size, 2.2 BCF day, those are just bearish news, fundamentally side, both in terms of end of season, end of draw season in March, and in end of draw season in November. So again, whenever Freeport coming out with an announcement that train 3 could be filled, then I'm okay. But again, it's a bearish news. It's a bearish news until I see those flows really coming. And then about the overall demand. Right now, I see for Henry Hub just 13.4 BCF a day of LNG export. I would love to say in the summer at least 15.5. And the guys expert in energy know that, 2 BCF day are really important in terms of end of season storage. So again, I really hope to have Freeport full soon. Otherwise, my idea is what I told you before. So it's really bearish. And, when I talk right now, the 12Z GFS ensemble for sure is not bullish in terms of weather. So if you ask me about trading, you know that until I see something good on the supply-demand balance side, then no worth assuming really bullish long position. And then the last point is related to the Freeport and TTF. You know that TTF right now is around 50 euro per megawatt hour, and the collapse has been huge. You all guys recall that ETF raised up to 350 in August, no? So the collapse has been huge. The history is the same, especially related to the one of the mildest winter ever, one of the mildest January ever. So actually, right now, if we have Freeport coming back with 2 BCF day, then it will create an even more oversupply market on TTF side. I mean, already right now we have less flow from Russia. Today we have kind of 9% of overall European consumption for 2023 coming from Tube and Russia. So we have plenty of LNG boats in Atlantic Ocean. So if we have 2 billion cubic feet more from Freeport over the next months, this will be really bearish in terms of overall supply-demand balance. And again, if we compare this with the storage situation on TTF side, we are right now in Europe 60% fill in terms of storage. Then you can say that the work that we can do to fill the storage up to November will be really easier compared to what have been last year. Back to you, Tracy.
And on that note, you mentioned you've had a very mild winter in Europe, and that certainly has helped. And we've also seen industry cut back on nat gas usage up to 20% in some countries. So how long do you think that can last? Is that permanent? Or do you think, you're going to see, because of these lower prices, you're going to see industry start picking up again?
Yeah, several points on that as well. Right now, on the weather side, we have a confirmation that can bring something bullish on Europe, especially. So this is the stratosphere warming that can bring some kind of blocking in Greenland. So what the Met call like negative North Atlantic oscillation. And so we can have some cold flowing in Europe, on the Europe side, and on the other side, we can have some cold in the east side for Henry Hub, in terms of lower 48 US states. Unfortunately, on the US side, the now negative is just one out of 100 elements that we need to have in order to have some cold. Instead, in Europe, we can have 4 to 5 cold days. And that's why we had a kind of rebound from 47 to 51 euro per megawatt hour. So again, March cold could be an help on the bullish side. On the industrial demand side, you get the point, Tracy. Indeed, we had 25% of industrial demand reduction since, I would say, September. And right now, we are seeing some kind of rebound in overall demand, even if we compare the last PMI data. So the manufacturing side in Europe is a little bit better, and I would expect some kind of industrial demand rebound. Having said that, we need also to consider the historical range of the European TTF. I mean, right now we are 50 euro per megawatt hour. And if we compare to the 10-year average, we had kind of, 10 euro per megawatt hour. So even today, we are 5 times higher compared to the historical range. So again, it looks to me that we are close to the bottom on the Europe side. But again, another point is related to the contango shape of the curve, both on this side and on the other side of the ocean, that we can address later on. Maybe, Tracy, back to you.
Well, and then one more question regarding this, since you brought up the curve that's in contango. I know a lot of people have been talking about, or wanting to talk about, trading like oil and some of these, UNG, which is only single levered, but things like oil that are double levered. Can you kind of impact, or kind of tell people the impact on contango on these ETFs?
Yeah, I would say this is the most important question of the day, according to my view, Tracy. And I did a lot of academic research on that, trying to estimate the impact of contango backwardation on the ETF and especially leverage product down the road. And so if there are people, right now trying to trade especially natural gas, but also oil, then I would really like them to advise to be careful related to contango. If we consider Henry Hub, right now we are in a situation that we call like kind of super contango. So again, if we consider the spread compared to the December 23 contract and the March 23 contract, it's huge. So again, it's more than 70 to 80 cents. What does it mean? It means that whenever we have a rollover of the future contract from one expiration date to the other, consider, for example, March to April rollover. Every time we have a contango situation, If the prices go down the next day after the expiration, then you start affecting the underlying financial instruments. So again, if you really want to buy Henry Hub natural gas, you have to have a target for December of kind of $4.5 per million British thermal unit, and not just say, I want to see 3 in December and then I'm okay. Otherwise, especially if you buy right now Boyle or UNG or other leverage ETF, then if all the other stuff are stopped in terms of supply demand balance, if the supply demand balance is the same, if all the other exogenous events are the same, then you just feel the impact of the contango negative roll yield that destroy any kind of leverage ETF. So what I can say is that in a situation of the super contango, in general, bearing all the other elements, is better to hold a short position in ETF rather than a long position. Obviously, if we had a production cut, a kind of impressive power burst demand, a very hot summer, and we spike kind of $3, then you gain. But otherwise, just be careful in accumulating whenever you have huge contango. Back to you, Tracy.
Excellent, thank you. And back to Nas. So everybody's talking about China demand, right? And you kind of talked about a lot about China demand as well. You know, there's a huge variety of expectations among analysts, how much demand is really going to come back. Can you kind of walk us through your views and your concerns there?
This question for me, Tracy?
Yes.
Okay.
China demand.
Thank you. For those who are interested, we have a free report which is available on Twitter and on the web, which is our 2023 oil market outlook, which we still stand by today. We have not seen changes since we published it in early January, and it includes a lot of discussion on China. Now, whatever we published, basically, that was the short report or the conclusion. The long report, basically, we have not published it. But the idea here is the first growth that's happening in demand in China is related to the transportation sector. But the economy itself needs time to rebound. So what we have seen so far and what we are seeing is the rebound from the transportation sector. We still need until the end of the year to see a rebound in other sectors, and therefore most of the impact of the reopening is going to happen toward the end of the year. Our growth in global oil demand is probably, as some people labeled it, as low relative to others. We believe the growth is going to be about 1.4 million barrels a day, simply because China's recovery is going to be a little bit late. China's economy is suffering. Remember, we had all this drought and all the closures and all those problems. But the issue that everyone should be aware of, and you asked me this question because of this, a rebound in China and increase in demand, whatever that amount is, we have to be careful when we talk about its impact on oil prices. And the reason why, because China's oil inventories today, that's commercial and the SPR, is way higher than that of the United States. And our estimate is about 1.1 billion barrels. That's underground and above ground. And probably 1/3 of that is strategic petroleum reserves. China is not shy about using strategic petroleum reserves to make sure that prices do not rise. So they are going to use the SPR exactly the same way they did in 2018, in 2019, in 2021. And some of you heard me saying this before, that the only reason why we did not get to $100 oil in 2021 was China's SPR. The whole oil market structure has changed, completely changed. Before, we used to talk about, for those who remember their Econ 101, We used to talk about oligopoly because it's all about producers, OPEC, and then OPEC plus, and government regulations, etc. But now that's not the case. The market structure changed. Now we have something we call oligopsony, simply because China is entering as a big buyer who can influence the market. In a sense, China is standing in front of OPEC. So it's really, remember that economists cover shale versus sheiks? Well, the truth, that was not true. I think it was really the bear versus shale. What I mean by bear, Russians, and still it's Russian versus shale. But when it comes to OPEC, it's really OPEC versus China. And China is going to use the SPR. And OPEC is no match to China's SPR. The same way the Biden administration released 180 million, China can release that without any sweating. And therefore, the reopening of China's economy and the increase in oil demand, even if it's way higher than our expectations, does not mean an increase in prices that match that increase in demand. There will be an increase in prices, but not much, simply because China is going to use the SPR. Back to you.
And then, what are your thoughts on Russia? Because there's also a lot of differing opinions on, how much Russian barrels are going to be off the market, on the black market, on the gray markets.
Since late February 2022, for many, I can see many faces attending this space here who were in those spaces in late February and in March, where they heard me talking about the fact that Russian oil will flow no matter what. We have enough experiences in Iran, Syria, Sudan, Venezuela, and others to show that Russian oil will continue to flow. And that's exactly what happened. Now we are seeing some issues. And I just want to explain one reason for the Russian discount, because this is very important. The first point is, yes, the EU wants to lower its dependence on Russia. But let's remember the fact that since 2014, Russia wants to lower its dependence on the EU anyway. So this is coming from both sides. It's not only one-sided story. The price cap have no impact. Yellen is going crazy. Yellen is obsessed with the idea of price cap. The price cap never worked. The price cap never had any impact. The price cap did not lower Russian revenues. It's a joke when Yellen says it lowered Russian revenues. It takes at least 2 to 3 months for companies to get paid. And the price cap was imposed on December 5th. They haven't even gotten paid to say that Russian revenues declined because of the price cap. It's a lie. So Russian crude is flowing. Russian products are flowing. But the problem is, to convert shipments to Asia, the distance is multiples of that to Europe. So Russia has to mothball the cost of the extra shipping to Asia, and therefore the difference, therefore the discount. But the problem is there were not that many ships, there were not that many tankers, and therefore shipping rates went through the roof, and the discount has to be $40, $45 to compensate. At the same time, they have to be attractive to India and China, so they have to lower the prices relative to the Gulf and Iraq and other nations. So we've seen that discount, but most of the discount is related to the shipping cost. What we've seen since last May is that Russians and Chinese buying all kinds of secondhand tankers, and they bought hundreds of tankers. And the existence of those tankers right now, that means we have more ships more tankers carrying oil from Russia to China and India and other places. Most of them are ghost ships. And that reduces the discount. And therefore, we've seen Russian oil basically going up from about $38 to $45, $44. simply because we have more ships and the discount went down. And as time passes by and they become more efficient, the cost will go even lower and the discount will go even lower. And our question here at the firm is, well, if the discount becomes lower, what would India do? Because India is one of those price-sensitive countries, and where would they shift to? And any way you look at it, whether you look at it as something happens in Russia, any decline in Russian exports, China problems with Russia, India is not satisfied with Russian prices. The country that everyone will compete for its oil is Iraq. There will be a competition for the Iraqi crude. And the question becomes here is, will the Saudis and the Emiratis increase production in this case? That's remained to be seen. The cut, the 500,000 barrel cut, in our oil market report that I alluded to, and again, everyone can read it on the web, we expected that Russian oil production and exports will decline by about 600,000 barrels a day in 2023. So we were almost spot on because they announced 500. The only issue is, until today, we don't know how much of it is products and how much of it is crude. We don't know how much of it is related to refining maintenance, because we are seeing this right now, and whether this is permanent or not. Here is a joke, and I will end with that. As you know, OPEC Plus had month-to-month meetings. So they have monthly meetings, and everyone was watching those meetings. And then that's ended last December. All of a sudden now, the Russians are coming up and saying, well, I'm going to tell you about my cut every month, reverting to the same dilemma we had with OPEC earlier. Back to you.
Yeah, that was my next question to you. You just covered it on the 500 cuts. You know, and I think that, and I don't know if you would agree, but I think maybe partially the reason they did that was to kind of tighten that spread between, say, Urals and Brent.
Absolutely, absolutely. I mean, it is very clear that, and there is another reason. If all of this happened at the same time when they did two things. The first one is they instituted a new method of calculating taxes based on the spread to Brent, or the difference to Brent. That's one, which means that they want to prevent competition among Russian companies selling the oil at a lower price. At the same time, they want to guarantee a minimum to the government. And it was suggested that because they don't want to provide any tax breaks to the companies, that some areas are too expensive to produce at that price, and therefore they needed to cut. The suspicion is old, but it became a stronger suspicion at this stage. Let me just give you those numbers. The break even for Russian oil with taxes is $55. Most of the cost in Russian oil are taxes. Russians, without taxes, they can survive at 22. They can survive because the average cost probably is about $18 without taxation. But all of it from 18 to 55 are taxes. So the government have to literally reduce revenues if they want to continue exporting. But you are right about the spread.
Perfect. Thank you. Back to Bob. Let's talk a little bit more. Let's talk a little bit more about U.S. data. So, generally, I mean, unemployment continues, or I should say, employment continues to be very resilient. Right, we've all kind of touched on that a little bit, which is usually a good sign for oil prices. However, normally when we would see a great employment report, you'd see an uptick in crude oil, but we haven't been seeing that. And so, your thoughts on perhaps why, and then perhaps what other like high frequency U.S. macro data may be weighing on crude price as well.
Well, I'll refer back to, I forget which one of the other guests said it, but manufacturing is kind of the key here. because obviously we've seen transportation in the form of flights and automobile usage and stuff increase to pre-pandemic levels, in some cases surpass it. But the manufacturing side globally, not just here in the US, not just in China, but globally, manufacturing has been slow to recover. So to just touch on the second part of that question, to me, the most important thing right now is to a certain degree PCE, but not CPI at all. I'm looking at ISMs and the PMI data much, much more closely than I did, say, 6 to 12 months ago. And the reason is we saw some of those S&P PMI figures, which for people who don't know, the S&P PMI is generally smaller to medium-sized companies, relatively speaking. And then the ISM is the mega cap companies, the much larger manufacturers. And we saw a lot of positive beats in that plethora of S&P PMIs that we got between the UK, the EU, Germany specifically, and the US as well. And the data was across the board. It was mixed, but in general, it was better data. And now next week, we get some of the non-manufacturing ISM. We get some manufacturing data out of China. And that's really where I'm looking for the demand increase to come from, both for natural gas and crude oil. And if we don't get a manufacturing creep higher and back into expansion territory, that's the other key. These PMIs and ISM data, the fulcrum is 50, and below 50 is contraction, and above 50 is expansion. And if we don't see those kinds of things start to generate above 50, readings above 50, then you can see this trend this channel rather that I talked about continue, and maybe even push lower toward the $64, $65 handle. I would still say that the larger move would be higher. And again, if I'm talking about the lower end of the channel being about 72 or 73, a move down to 64, 65 is not that much. But if the upper end of the channel is 84, 85, and we move up to 100, that's a more pronounced move. That's the kind of move that I'm looking for in terms of calling it a breakout. So these ranges that I talked about that crude goes in, the sideways ranges, generally vary from about $10 to $14. And you need a much bigger trending move to get a breakout. And I would say that the key piece of data now globally to start looking at is those ISMs and those PMIs, and see if they continue that tiny little grind into stronger territory, moving out of contraction, and some of them moving into contraction, specifically the manufacturing parts of it.
And this is a little bit not on oil, but since we're talking about it, what do you think? We've seen services be really sticky, right? As far as inflation, like we see restaurants, and we have. So, what are your thoughts on how initially my thoughts were a year ago, 2 years ago was, it's because it's pent up demand, but it's remained high. and we've seen credit card debt go up, and we've seen savings go down. And so your thoughts on, why is that sector remaining really strong?
Well, the thing I find myself breaking down for a lot of people on the inflation question is that services inflation, essentially think of it as wages, because it's really what it is. I mean, there's other components, obviously, but you're not talking about the copper that goes into a product. You're talking essentially about wages, and healthcare is in there as well, and certain part of housing is in there. But those things tend to be sticky for the simple reason is the only time that wages go down, and I'm talking about salary and benefits in there, is when somebody gets laid off. You don't see a situation where somebody says, look, I really want to keep you. I'm going to give you this raise. We're doing okay. I can afford to pay you a little bit more. And then that same boss, I'm obviously simplifying it, but that same boss coming by, 6 months later and say, hey, we're not doing so good anymore, so I'm going to take that raise away. That's just not the way that it works. Generally, they start cutting hours and then they start cutting people in order to pull back services inflation. Again, it's not entirely wages, but it's a good way to think of it. So from that perspective, that level of inflation stays sticky. The second thing is people talk, let's use the CPI. The PCE is the same thing, but let's use the CPI for this example. The CPI, the Consumer Price Index, is exactly that. It's an index. And many people look at it and they say, okay, last month, CPI was plus 0.3% month over month, plus 6.1 year over year. And this month, by the way, I'm making these numbers up. And this month over month, it's plus 0.1, and year over year, it's plus 5.9. Okay, prices are falling. They're not falling. As a matter of fact, they rarely fall. If you go to the St. Louis Fed's, the FRED website, and you type in consumer price index, you'll look at basically a straight up from left to right with a couple of little dips. And those dips happen during recessions. But otherwise, inflation is either rising, I should say prices are either rising quickly or in a slow, controlled manner. And that's why we've heard the Fed for decades now say we want a stable inflation rate of 2%, because that's the level they feel wages can keep up with. But when we have the wages just skyrocketing in order to offset how quickly inflation skyrocketed, well, now you've got this wage price spiral. Now, we don't technically, in my opinion, have a wage price spiral yet. We don't. But we do have to have wages go up a little more in order to catch up to inflation. And if the Fed were to do it exactly correctly, which they've never done, in my opinion, I shouldn't say correctly, if they were to time it perfectly is more what I wanted to say, then you would see wages continue to rise at a slower rate and prices stabilize or even fall, so that people's wages could catch up to the cost that they're paying for goods and specifically services. That's a really hard needle to thread. And that's what the Fed is trying to do, which is why earlier you asked me if the Fed is stuck. And I said, yeah, they're pretty much stuck. There's so many parts of the early run of inflation that they couldn't cause because they were supply chain related. Now you've got the part where it's services and it's cost of housing, and those things they have a dramatic effect on. But they take longer, and there's pain that goes with them. So that's the trick bag they're in. So when you say, can the Fed do anything? I mean, yes, they can stay on this course, and they will cause, in my opinion, a recession. They will. And then that will, over the course of time, cause inflation to drop a little bit through services inflation falling. Goods inflation collapsed pretty quickly, and now it's starting to tick back up again slowly in some sectors. So that's the worrisome part, is that we haven't gotten any movement on services inflation, and goods inflation, they're starting to tick up. So you almost, if you're sitting in the FOMC meeting, you want the recession, you just can't say it.
So, yay. so good on that. All right, we're running over an hour now, and I don't want to take up our guest's precious time. So I just want to go do my usual. Let's go around and your final thoughts on what should we be looking at and what should we be focusing on, and anything that you want to cover that we didn't get a chance to cover. So I'll start with Andrea.
Thanks, Tracy. So on my side, nat gas side, what I'm focusing over the next couple of days for sure is March contract expiration. So right now you are seeing, for those who are watching the price action during 12Z, some kind of volatility due to March option expiration, and then you will have the H future expiration tomorrow. So once March going away, then our focus is April. So April side, 3 to 4 points. So what I call before the negative Atlantic oscillation, so the Greenland blocking on the weather side. Next week storage, which I expect around minus 70 draw, another not exactly bullish storage number. And then the Freeport number related to the next daily supply demand balance. So again, weather, storage, and Freeport on my side. And Tracy, back to you with our contango as well.
Excellent, thank you. And Dr. Knox, your final thoughts and what should we be focusing on?
All right. One issue that we've noticed recently is that we've seen increased activities in the western side of the Permian in New Mexico. And yes, the shale companies been reporting record high profits, as we've seen with Pioneer and Diamondback and others, and they returned massive amount of money to investors. But the problem is, if you look at the results of the drilling activities in the western side of the Permian, which is mostly federal land, by the way, most of it basically are condensates and mostly NGLs. It's not crude. And that raises questions because companies get lower price for that. It is very clear that production of gas continue to go up in this area. So where this is going to lead us? If we study the history of the companies, we found out that every time the companies ended up with this trap, they reversed course and they drilled either somewhere else or in a different zone. And that takes about 3 months. So we are going to continue monitoring this in the next couple of months to see whether companies are going to shy away from the western side of the Permian, or they are going to change drilling in those zones because they are bringing a lot of liquids, and those natural gas liquids are literally going to lead to two results. One of them is negative natural gas prices in some hubs, and the other one is a lower price for NGLs, which means that the percentage of NGLs to WTI is going to be lower. Back to you.
That's very valuable information to be watching. And then Bob, what should we be watching? Your final thoughts.
I'm gonna just rehash a little bit of what I just said. I think that the PMIs and the ISMs, including those out of China, they have an NBS manufacturing PMI coming out sometime next week, are very important to watch to see if they go into expansion. They continue in the slight upward trend that they've been in. The second thing I would say is just from a perspective of overall risk assets. If you go to the CME Group Fed Watch tool, and all you have to do, for those of you who've never seen that before, just type in CME Fed Watch tool, and it's one of the first things that comes up. And you'll see the probabilities based on the Fed funds futures as to what the market thinks the Fed is going to do. And there's a tab on the left-hand side that says probabilities. And as of right now, the meeting probabilities are still pricing in the highest probability of a December rate cut. I think that's nuts. I don't think that they'll do that short of something in the economy breaking or some sort of massive geopolitical event that can't be predicted. And so it's not a big advantage in terms of probability. Right now, the rate staying the same is at 32.1%, and the rate cut is at 34.6%. And by the way, that's at 5.25, 5.50 on the Fed funds rate. So I would keep an eye on that shift as well, because sometimes you can sense an underlying change in the mood of the market, and it affects commodities as well if there's a large shift in that. We recently had a large shift where the first rate cut was actually priced in September, and then it shifted out. And then it was priced in November, and it shifted out. And I'm waiting to see if that December one shifts out as well, or if they start pricing in rate cuts again. And I suspect if we had weak ISMs and PMIs, they would start to bring those cuts back in, because still the market just does not believe this Fed. And I think that's more about the Fed having managed other cycles. We can talk in another space whether they should be managing anything at all, but they have managed other cycles pretty poorly, pretty darn poorly. And I don't know if they're going to manage this one correctly or not. That's not my job. So that's really my last thoughts. And thanks again for having me, and thank you to the other speakers.
All right, guys. Thank you. Thank you, Anas. Thank you, Bob. Thank you, Andrea. It's been a pleasure. Thank you for taking time out of your busy days to talk to us. Please follow @PlaceYourTrades Twitter handle so that you can see our other upcoming events. Everything that we talked about, I will post to Twitter. I hope everybody has a great rest of their day, and next week's spaces will return on Wednesday. Thanks,
Tracy,
everyone.
may I make a comment, please?
Yeah, of course.
Thank you. Just for everyone in the room who does not know, I tweet a lot of tweets, valuable information in Arabic. And Twitter provides a translation service. It's on the bottom left of every tweet. So if you want to see what we are saying in Arabic, all you got to do, just press that translate button. Thank you.
Excellent. Follow everybody up here. They all provide valuable information. And again, I'll see you guys next Wednesday. Thanks, everyone.
Bye. Thanks, Tracy. Bye.